on to some important macro opinion then. Lata Venkatesh caught up with Vivek Rajpal and Rob Subbaraman of Nomura India and began by asking if they expect the RBI to cut interest rates in the February meeting and their expectations from the budget. Take a look at that conversation.
We expect monetary easing from Reserve Bank of India, but not in February. We believe RBI is dovish and probably will turn dovish. They will turn from their stance from calibrated tightening to neutral. But still the data is not very clear for a February cut because as you know, core inflation is still sticky. And I think RBI is doing enough in terms of liquidity infusion. I mean, let's not forget that bond yields have fallen significantly since October. So there has been a decent easing since then. And we do have like fiscal uncertainty as well. So yes, we believe easing will happen, but we are calling for a later cut later in the year in Q3 rather than...
In Q3? So yes. Not even in April?
Well, we have to see how data pans out. So for example, if really core inflation turns out to be lower, then there is always a possibility of a cut earlier than our base case. Having said that,
so what prevents RBI would be that core inflation is
Absolutely.
at 5.7 and therefore certainly not a cut in Feb 7
Absolutely,
policy?
Absolutely. I think easing in the form of liquidity infusion will continue, OMO buybacks will continue, and that will push downward pressure on the yields, but in terms of a repo rate cut, market has to wait.
Okay. Well, what's your thought, Rob? Of course, Nomura would have one view, but would you worry that there could be a large amount of fiscal looseness, if not monetary looseness, in India? What are you expecting from the Feb 1st budget in India?
We're actually expecting it to be fairly prudent. I know there's a lot of expectations of populist policies, particularly towards the rural sector.
Yes.
We think there'll be some of that, but we think they will do their best to try to achieve the 3.3% of GDP, and we think that will be achieved, and they will set a target of 3.1 for the next financial year.
This is poll season. The ruling party has not done too well in the last 3 state elections. You still think that you can bet on fiscal prudence for FY19? Well, that's your base case.
This is our base case, that the government recognises that if it starts to become missing these targets, markets can start to punish. And it's very important for India, which historically has had high public debt, to get its fiscal finances in order. And it can then be also rewarded by strong capital inflows, which can also support growth and provide better fundamentals over time, a stronger currency as well. So it's a tricky one because I think the trade-off is, if you try to really achieve this target, with populist policies, something else has to give, and then it can affect growth in the near term. On the other hand, go for growth and populist policies, and then you have fiscal slippage. So it's a tricky one to balance. I think the thing that I think foreign investors and everyone's going to be watching is the details. The devil will be in the details. Even if you hit 3.3% of GDP, how realistic is the revenue assumptions? How much spending has been kind of pushed into the next fiscal year? So I think that's going to be looked at carefully. And I think it's getting harder to mask those things. I think investors are smarter than they used to be.
Exactly. That's exactly why I'm surprised that you think 3.3% will be achieved in the current year. The CAG, the chief auditor of the country, has just released a report pointing out to masked fiscal deficits in the Food Corporation and other government-owned entities which borrow in lieu of the government. Plus the goods and services tax, the newly imposed GST, has consistently fallen short of achieving its target by at least 100 billion rupees every month. So, when you take the total tally, it's a tidy shortfall. You still think that they'll be able to achieve this year's target and still promise a 3.1 next year?
That's our base case, and we think there will be some massaging of the data to achieve that. But you have to remember, last year, the rupee was under a lot of pressure. Part of it was because of twin deficits, right? So I think that is something policymakers are understanding more, not just in India, but in emerging markets.
Okay, so that was some commentary on the macro opinion, but after this short break, we'll get chatting about the micros because Z Entertainment will probably be the stock of the day. The management and the SL Group clarify after the news of SFIO probe in company's transaction services and makes the stock tank 30% on Friday. All the details when we return.